Are houses just too expensive? Is the American dream over? Can you even think of buying a house anymore? So those are big questions. And when it comes to housing prices, it's insane out there. Houses cost so much that it's changing what it means to live in America. However, if you want to find a way to reverse your fortunes and benefit from rising prices, I've got just a show for you today. Now, I'm not going to talk about flipping houses or owning an apartment building. I've got something much simpler for you to do, and I've got some specific ideas for you. And I'm also going to bring in a world-leading expert on real estate investing to help us figure it all out. So stick with me for a few minutes. My guest today has some very cool things to share, and you should also know he has a big story about a monster real estate deal that will lead to a huge land rush. He has the specific investments to back it up. So you can check that out at landrush2026.com or using this QR code, and you'll get all the details. So for today, I'm Matt Weinshank at Stansberry Research. I've been working in the investment business for nearly 20 years. And look, houses have gotten so expensive, no one can buy them. The average first-time home buyer just crossed 40 years old. Now, back in the 1990s, folks bought their first home in their early 30s. But if a house costs, let's say, $500,000, depending on where you live, what 30-year-old starting a family has saved up $100,000 for a down payment? Between inflation, the cost of college, and don't even get me started on childcare, it's simply unaffordable. So we're all rewriting the American dream to leave out the goal of owning your own home. And affordability has become the key political issue of the day. So, all right, what can you do? Well, prices are rising, so you should be an investor. But you might be surprised to hear that no one's investing in real estate. They're letting this boom pass them by. But when you watch the market, you can see that's changing, and it's setting up an opportunity for those of you in the stock market. So, let me be specific. You may be thinking about home flipping or becoming landlords. That's not what I'm talking about. I'm talking about institutional and everyday investors buying real estate in their brokerage account. After all, you can do that in seconds with a real estate investment trust or a REIT. REITs are a one-click way to buy into real estate that's operated for rental income. No big down payments, no deadbeat tenants, no leaky toilets. But even as we watch property prices soar, REITs have been left out of this burning bull market. That's both true in 2025 and over the last 3 years. REITs have long been a key way for investors to generate income, but even in my income-focused advisory service, Income Intelligence, we haven't found a compelling REIT opportunity in a while. They simply weren't moving. However, that's changing. REITs are about to play catch-up and reward the investors who've been waiting patiently. So let's step back and just talk about REITs for a second. REITs are companies that own and operate real estate in the pursuit of rental income. They have a special tax structure that allows them to pay little to no corporate tax as long as they passed on most of their income onto their shareholders. So there are REITs that buy and operate apartment buildings, offices, shopping malls, data centers, and more. And here's exactly what I see happening right now. So you can start at the most simple level. REITs are starting to move. If you're a technical trader, the 50-day moving average has passed the 200-day moving average on the MSCI US REIT Index. This generally indicates an uptrend, and using this signal alone would have rarely steered you wrong over the last 15 years. Each crossover signaled a continued rise, with the biggest exception of the 2022 bear market. And we see another signal in our more proprietary indicator. In our income-focused service, we have a special indicator that scores income-paying assets for when they offer good yields and momentum. The system works, and today it likes REITs. But there's more to it than these simple technicals. When you start digging in, you see warehouse and logistics REITs like Prologis have started to rise. Healthcare REITs in particular are taking off, and those are companies that own properties connected to healthcare like hospitals, doctors' offices, and you can see that in a company called Ventas. And classic residential plays like Equity Residential are just now reversing a slow decline. And it's that decline that leads us to a second thought. REITs are remarkably cheap. The S&P 500 trades at like 25 times earnings. The MSCI US REIT Index trades at just about 17 times earnings, and that gap is the biggest it has been in more than 20 years. That's because investors have completely forgotten about REITs. Here's a way to look at it. Each month, Bank of America collects data on the positioning of institutional fund managers, and right now, the allocation to REITs has dropped to levels near the aftermath of the global financial crisis, when real estates and REITs were shunned as toxic assets. So yes, it's fun to hop on the hot trend, but skilled investors know the opportunities come where no one is looking, and no one is looking at REITs. But again, that's changing. And there's fundamental reasons for that too that are going to send REITs higher. The big one is interest rates are falling. The Federal Reserve has broadly been on the path towards lower rates, and the yield on the 10-year government treasury has dropped from 4.3% in August to 4% today. And interest rates matter for REITs in two big ways. So first, when investors can earn less in a bond, the yield on REITs look more attractive and investors buy them up. And second, property values rise when interest rates are low, which increases the value of the REIT's property holdings. And aside from interest rates, the fundamentals just look good. Across the industry, REITs have been growing their income at about 2.8% per year for over 3 years with really good consistency. Occupancy rates are high at 90%, and rents are on the rise. Now, you might not like high home prices or rising rents if you're out there looking for a home, but as an investor, that is the perfect setup. Individual investors have completely forsaken REITs over the years. After they had a huge boom in the housing boom back in the mid-2000s, they've slowly commanded a smaller and smaller portion of investors' portfolios. I suspect you are in the same position. You probably own very few REITs, even though the time right now is right. So it is time to change that. To get started, you can look at an easy REIT index fund like Vanguard's Real Estate ETF. It trades under the ticker VNQ. It buys basically all the REITs in the market, charges very low fees. You can get it in almost any brokerage account, including retirement accounts. It pays a dividend around 3.5% and has returned nearly 8% per year since its inception 21 years ago. So here's the lesson. If you're concerned about affordability, hedge away some of it by owning real estate. If the AI bubble pops, real estate looks like a safer play. And if you're worried about tariffs, you don't pay tariffs on your rent. And if the dollar continues to decline, real estate will increase in value as a valuable tangible asset. So all the pieces are in place for a big catch-up move. So keep looking where Wall Street isn't. That is why I brought in Brad Thomas. He's the perfect guest for today. He's got more than 30 years experience in real estate, having first worked as a real estate developer. He's literally written the book on REITs, having written both The Intelligent REIT Investor and even REITs for Dummies. Now he's an editor at Moat Research, which publishes great work for everyday investors like you. Brad, thank you for joining me. I want to start with giving people a tour around the REIT industry. You know it better than anyone else, so I'm going to ask you about a type of property, and you tell me if I can invest in it through REITs. Does that sound good?
Yes.
Okay, so hospitals.
Yes.
Shopping malls.
Yes.
Government offices.
Yes.
How about storage units?
Yes.
What about refrigerated warehouses?
Yes.
What about trailer parks?
Yes.
Nursing homes?
Yes.
What about like a warehouse just to store paper files and records?
Yes.
How about casinos?
Yes.
What about like a tower that you see with antennas on it to connect cell phones?
Yes, for sure.
And what about car washes?
Yes.
All right, so I mean, to me, this is such a fun industry. It's almost crazy. You could do basically anything and everything to generate dividends and income from all these kind of properties. So I just want people to understand how versatile this industry is. But let's take it back a step. You're obviously a big fan of REITs. Why do you think every investor should own REITs in their portfolio?
Well, first of all, Matt, you just mentioned some of the sectors, and there's quite a few other sectors that we left out. When I started in the real estate industry many decades ago, Most people looked at real estate as just the core asset class would consider, residential, retail. But now, as you mentioned, it's expanded into a large number of categories. And you just touched on a few, by the way. So what's really an interesting value proposition for REITs is that this is such a fragmented marketplace. I don't know of any other asset class, Matt, where REITs, institutional REITs, own around 10% of all U.S. commercial real estate here in the U.S. And that doesn't consist of the houses that you just talked about, but I'm talking about the rental income, the rental properties. So there's a number of sectors that we haven't even touched on yet, and that whole industry is growing. So just the growth of the industry being highly fragmented. So these public REITs are going to continue to consolidate and become larger and larger and larger. So when we're looking for growth companies that are continue to grow, definitely look to the REIT sector. Most people don't look at REITs as growth opportunities because they're just looking at income. But I want to really point out that the growth opportunities are there. Also, REITs they were formed in 1960. So that's decades, 6 decades ago, where we have so much information we can rely on and look at how REITs have performed historically over time and how they've navigated through multiple economic cycles, including the last big one we know of called COVID-19. So I think that's another thing to consider is the durability of this particular asset class. As you pointed out, REITs by law must pay out at least 90% of their taxable income. And I think this is probably the biggest attribute for investors to think about in terms of REITs, because these companies must pay out 90% of their taxable income. Most pay out close to 100%, and that's what makes these dividend yields so high. So most investors are gravitating towards these higher yielding stocks that are able to generate consistent and reliable earnings and dividends. And obviously, just like you, Matt, we like companies that increase their earnings and increase their dividends. And so those are probably the primary attributes. And finally, of course, these are publicly traded stocks. So unlike owning a duplex or any private real estate, you have liquidity. You can sell these companies at any time. And I think having that liquidity is another big part of the value proposition for REITs.
Yeah, they're a great way, to get, instead of buying one property, you can get diversified with, with $50, right? So they're really appealing, and the argument for real estate just makes sense, right? It's good inflation protection. It's got a lot of intrinsic value that it really can't lose. But what about the timing here? I kind of gave my pitch for why now is the time for REITs. Do you agree? Is there anything I missed?
Matt, I think now is the best time. As I said, I've been in this industry a long time, and both as a developer and then 15 years of being a Wall Street analyst, Wall Street writer. And I came out of this Great Recession is really how I became a writer. I went through some very difficult times in 2008, 2009, as most did, who owned any form of real estate in the Great Recession. But even those prices then, I think we see a better opportunity today in the REIT sector. And again, a lot of it has to do with the earnings power of these companies, their cost of capital. As you know, the key drivers for companies is their cost of capital. And so when you pointed out the interest rate cuts, we've got that catalyst in place, that cost of capital is being lowered. So I think now when you look at valuation and you look at the earnings histories and trajectory for the REIT space in general, I think now is the best time ever to own shares in real estate investment trusts.
Yeah, I mean, the real meat of a REIT play is they're going to earn this sort of return on renting it out, and they got to pay this interest rate, and they earn the spread. That's essentially all it breaks down to. So if that interest rate comes down, they can get a lot more profitable really quickly. I think that's what a lot of novice investors miss, that cost of capital side.
For sure.
So for an investor looking at REITs, is there a particular business model or a setup or a type of REIT that you think they should be looking at?
Yeah, so, I wanted to show you this chart here that shows all of the different sectors. And again, there's a lot of historical evidence. We can go back and look how REITs have performed. Now, this particular chart I'm showing you they say it's probably hard to see on the screen, but it shows a lot of colors. And all of the property sectors that we have here, from an office, industrial, healthcare, hotel, self-storage, shopping centers, malls, net lease apartments. And there's subcategories as well, like manufactured housing and timber, cell towers, etc. So when you look at all of these sectors and the performance, and by the way, some of the best performing sectors that we've seen, at least over the last decade, have been what I call the technology names. I like to call it the technology trifecta. And what I mean by that, Matt, is there are three sectors that have generated the best growth and, frankly, the best returns over the last decade. And those would be the data centers, the cell towers, and the warehouses. And, of course, logistics, as you know, is a lot of that is technology-based now. So especially with AI coming into the fold. So you've got this enhanced catalyst within technology with AI that's really fueling this demand within the data center space, within the warehouse space, and within the cell tower space. But the sector that I really like right now, and I know it best because I spent a lot of time in this sector when I was a developer, and that is the net lease REIT sector. Now, a net lease REIT is simply a freestanding property like Advance Auto. I used to build for the company years ago and built a lot of their facilities around the southeastern U.S. Companies like Dollar General also used to build for them, or like Walmart, for example. And so these are typically, companies that locate on one parcel of land. They don't have neighbors. They don't have to compete with the traffic of these other tenants like you would with a shopping center, for example. But the biggest attribute for this particular sector is these are long duration lease contracts. So they typically range from 10 years to 20 years, on average of about 15 years. So you get these long-term contracts, highly diversified with a number of different properties, literally hundreds, if not thousands, of properties in these REIT portfolios, which generates very reliable and consistent earnings. I'm going to show you another chart here, Matt, that shows all of the net lease REITs in our coverage spectrum, which totals just under 20 different companies. So you've got a lot of different varieties of net lease REITs. The largest is Realty Income. Actually, years and years ago, I sold buildings to them, so I knew them a long time ago. I've seen multiple CEOs with this company, going all the way down to some of the smallest companies. But they're all really different, and they're unique in how they source assets and frankly, how they generate value. And some of them actually don't generate value, and we like to point those out too. So I think this is the sector that I really like the most. I'll also show a second chart for you here. This is performance. And you can see here there's been a pretty big variance of performance for all of these different companies, especially this year, and you can see on and on. But the biggest thing we look for, Matt, not only within the REIT sector, but within all of our coverage of all of our income-oriented companies, is, as I pointed out earlier, is their cost of capital and how they are able to manage. The game is all about a spread investing business. So this chart here identifies the companies with their debt ratings, and some of those companies have investment grade ratings from S&P, Fitch, and Moody's. But you can see companies at the lower end of this chart, like Essential Properties, with 27% debt, so very, very well-balanced capital stack there, all the way up to companies that have significant debt. And what we found is the companies that are able to generate the most reliable and predictable growth and dividends are those companies that have lower debt, and they're able to manage that cost of capital and generate consistent investment spreads within their portfolio. The last chart I want to show you here is valuation. And I wanted to leave you with a few potential opportunities here. And this chart shows, you can see, well, obviously we look at the traditional dividend yield is one indication of value. We also look at the price to FFO, which is the funds from operations, is the earnings metric we use for REITs. And you can see there's also a variance of valuation between those companies that have low multiples and high multiples. I always point this out, Matt. Just because the company generates a high yield does not mean you should buy the company. I would not recommend anybody go out and buy a REIT or any income stock just for that yield alone. So that's why we do a lot of work here at Moat Research, understanding the fundamentals of the company and their business models and meeting with management. But just because those yields are high doesn't mean you should buy those. So the last thing I want to point out here for you is there's three companies I really like a lot in this sector. I'm going to start with Realty Income. That's the company I mentioned earlier. They're the largest net lease REIT in the space. You can see here utilizing this chart. We use this a lot. It's called fast graphs. But I put a line here showing the multiple for this company is 13.7 times. The normal valuation for this company is 17.2 times. Now, you can see that margin of safety that exists with this company. So they're definitely trading at a discount. And they have been, as you point out, Matt, over the last really 2 to 2.5 years, REITs have really sold off. But we think the opportunity set is in place. This company is still continuing to generate earnings growth. And I want to point out, there's only 1 year over the last 25 years or so, or 27 years, I believe, that the company has had negative earnings in only one year. Even during COVID, the company was able to generate positive earnings growth as well as positive dividend growth. This company is a dividend aristocrat. They've increased that dividend for over 25 years in a row. Again, we see that margin of safety. The next one I really like is a newer company that formed really coming just before COVID in 2019. This is Essential Properties Realty Trust. Ticker symbol is EPRT. Now, EPRT's trades, as you can see here, at 16.7 times. Their normal valuation over this period of time here is 18.4 times. So you don't quite see that spread or that margin of safety that you had with Realty Income. But what I like with Essential Property Trust is their growth. They have the highest growth historically, and based on analyst consensus, they also have, which is about 8% this year and next year. They have the highest growth in the sector, and they're able to do that because they, as I pointed out earlier, they have the lowest debt, and they generate the widest profit margins. So I like EPRT a lot. Finally, and we've written about this quite a bit at Moat Research, is Vici Properties. Now this is a casino REIT. They started out as a casino REIT via the spin, or really the bankruptcy of Caesars, led to this portfolio of properties that that Vici leased back to Caesars. Now, we've been covering Vici since the start, and which is about 2017, or really they listed, I believe, in 2018. But the company has now expanded beyond casinos, and they own quite a few casinos. MGM is also one of their tenants, and they own a number of MGM facilities in Las Vegas. They are concentrated in Las Vegas, by the way, and that is a risk we certainly need to consider. But they've expanded beyond casinos into other, quote, these experiential type properties, which is like health and fitness facilities and these amusement park facilities, a number of other things that they've got into, again, to diversify the portfolio beyond casinos. And so this company, as you can see here, the earnings multiple is 11.9 times compared with their normal valuation of 15.4. They have sold off. A lot of that sell-off is due to the risk in Las Vegas. Las Vegas has slowed down a bit, and we spent a lot of time with management and a lot of these companies in Las Vegas trying to understand the risks that are in Las Vegas. But I like this company because, Matt, they have long-term contractual leases. In fact, these leases with casinos are 40 years. So, I can't imagine, MGM, closing one of their dominant casinos. That could happen. That's a risk, but I just don't see that happening. In fact, during COVID, Vici collected 100% of their rent during COVID-19. Now, the casinos were closed, the hotels were closed, but yet these companies have long-term leases, so they continue to pay rent and generate those earnings, and most importantly, those dividends for investors. So those are the three net lease REITs that I really like the most today.
And these are exactly the kind of companies I was suggesting people get into these days. And what people should realize is they're almost a little like rent is the last thing that doesn't get paid, right? They're a little more bond-like. Even if there's a little bit fewer people at the shopping mall or fewer people gambling that day, they still end up paying the rent until things get really bad. So that's exactly why you want to invest in these things. So finally, just a portfolio question, Brad. I know you love REITs, but I know you're often, say, hey, now's not the time. You're not just blindly following REITs along. But if someone has their retirement account, someone is just trying to think of how to invest their portfolio, what kind of percentage do you think that people should have in their in REITs in their retirement account?
That's a great question, Matt. And of course, I cover that in REITs for Dummies. But the answer is it really depends on the investor's risk tolerance level. However, I would say on average, I used to say 10% exposure, but now given the value proposition we see today with REITs, and as I mentioned, this is perhaps one of the best times I've seen in my lifetime to own REITs. I think that number's closer to 15%, especially when you consider the fact that Bank of America just said that they recommend 1 to 3% in crypto. I definitely feel like 15% is adequate for REITs. It's not nearly as speculative as crypto. Again, this is the stability of the sector and what I call the swan sector, Matt, the sleep well at night asset class.
Brad, that's great information. If you want to hear more about Brad's big deal that he's talking about, you should check it out now at landrush2026.com or scan this QR code to find out all the details. He'll tell you all about it. Brad, thank you so much for coming. As always, everyone at home, like and subscribe on YouTube so you never miss an update. And listen up, this week on Wall Street's going to go on break for the rest of the year. Enjoy your holidays. We'll be back after that, and I look forward to talking to you again soon.